Welcome back to the channel, everyone, the Millennial Messiah, and we are going to continue on with the reading from the book The Lords of Easy Money, and we are on chapter 12, Totally Normal, and let us continue on. During most of Jay Powell's career as a Fed governor, the central bank was working hard to try to make things normal again. This effort had been underway in stops and starts since at least early 2010. Back then, FOMIC members believed that the Fed's extraordinary interventions would be temporary, even coined a term for reversing the ZIRP and EQ programs, normalization, at least as far back as January 2010. The Fed was debating how to normalize. Credible arguments were made that the process could be completed by 2015, meaning that the Fed would have sold off the assets it purchased through quantitative easing and would have drained virtually all the excess cash reserves out of the banking system. This never happened. Instead, the bank decided to simply rearrange the definition of normal. Jay Powell entered this debate from a position that was quite close to Tom Honig's. Both gave voice to the idea that the Fed was a highly imperfect engine to drive economic growth in America. Honig's critiques drew from his decades of experience at the Fed. Powell's critiques drew on his decades of experience in private equity, and he used hard data and interviews with his industry contacts to make his critiques of QE both specific and alarming. Both men warned about the ways that the Fed was stoking asset bubbles as it chased relatively small gains in the labor market. But this was where the similarities ended between Jay Powell and Tom Honig. Powell, for all his critiques, never cast a dissenting vote. And Powell, unlike Honig, started to soften his criticism, and he ultimately became to embrace the policies he once criticized inside of the FOMIC's closed meetings. When this happened, Powell's star began to rise. Powell's glowing clout within the Fed was made clear as early as January 28, 2014, when the FOMIC members gathered in Washington, D.C. for Ben Bernanke's final meeting as the chairman. Bernanke was leaving the bank on good terms. His service had been like wartime service, and he was best known for the dramatic bailouts and rescue packages he oversaw in 2008. When Bernanke's last meeting began, it opened with sustained applause. The clapping came to a close when Bernanke's vice chairman, William Dudley, said, "We thought we'd do this just for a couple of hours," drawing laughter from the committee. What followed next was something akin to a royal ceremony with all its orchestrated pomp and circumstance. On cue, the Fed Governor Jeremy Stein nominated Janet Yellen to become the chairwoman starting the day after Bernanke left, at the end of the month. This was just a ritual. The U.S. Senate had already approved Yellen for the job at the start of the month, but the formal vote was part of the Fed's internal process. "I would like to nominate Janet Yellen," Stein said. "Is there a second?" asked the governor, Daniel Tarullo. It was Jay Powell who formalized Yellen's chairmanship role. "I second that nomination," Powell said. Yellen was approved. Yellen's tenure at the top of the Fed was remarkable in many ways. She was the first woman to hold the role, and she commanded nearly universal respect from her colleagues. Her intelligence was unmistakable. She had the tactical ability to quickly absorb the complex information relayed by the Fed economists at the beginning of each meeting, along with a deep knowledge of the Fed, the U.S. Department of Treasury, and the White House. But the constraints placed on Yellen's tenure were also remarkable. She would serve only 4 years at the helm of the Fed, and she would spend a great deal of that time trying to unwind the extraordinary interventions that she had advocated during the Bernanke era. During Yellen's first year on the job, the FOMC was debating a central question. Should the Fed even try to normalize? The unemployment rate was falling. The economy was growing, even if that growth was slow. So why not just keep printing money indefinitely? Why not even expand the quantitative easing regime and promise to keep interest rates at zero indefinitely? The Fed could create money out of thin air, which seemed harmless and free from costs. This is a side note. Obviously, we know from reading previous chapters and from the knowledge we've been gaining from reading this book that it was indeed not harmless or free from cost. It was the exact opposite. It devalued our currency, making our dollar able to. When you devalue a currency like they're doing, it means that the amounts of goods and services you can purchase go down. That's why it seems like every year, I'm sure every parent notices this, but it seems like every single year the groceries are more expensive, but there's less in your cart. And that's because of them devaluing our dollar. And because they've been doing this, this naturally means that we won't be able to buy as much because our dollar's value is less than what it previously was. Alright, anyways, that was my side tangent. Let's get back to it. There was only one big and compelling reason that many economists cited when they argued that the Fed should not normalize at all. This reason was the mysterious and near total absence of price inflation. The Fed's conservative critics warned about constant price inflation, and there was good reason for it. That's how things had always worked. Printing more money devalued money, which we talked about in my side comment, and caused prices to rise. But the defining characteristic of the ZIRP era was not inflation. It was the surprising and scary specter of deflation. Deflation is the state of constantly falling prices and its suffocating death spiral for any economy. People don't buy things when they know the price will fall. Companies don't make things when they know those things won't fetch a good price. The shadow of deflation was now hanging over everything. The Fed poured more money into the world's economic bathtub, but there was a deflationary hole at the bottom which no one quite understood, causing all that money to drain away without causing prices to rise. Nobody was more surprised by this than the Fed. For 3 years running, the Fed had consistently overshot its predictions of how high inflation would be. Experts grappled with this puzzle and pondered what might cause it even. By 2020, nobody was really certain. The prestigious Brookings Institution held a day-long seminar on the topic that year, attended by Janet Yellen and other leading economists. And the final verdict of the day's discussion might as well have been, who knows? Globalization probably had something to do with it. There were more workers working for less money, making cheaper products, and generating more cash savings. The Fed's own past successes probably also played a role. Because they kept expectations of the future inflation low, which calmed the bankers in a way that in turn really did keep inflation down. One important thing about this, from the Fed's perspective, was that the absence of price inflation disguised the extravagant inflation occurring in assets. As long as prices didn't rise, the Fed had license to keep intervening aggressively by printing more money, which stoked asset prices yet further. Jay Powell in 2014 was determined to highlight the costs of the Fed actions. He, as much as anybody inside the FOMIC, was pushing for the Fed to normalize. In June, when members of the FOMIC gathered to a debate, he presented a clear case for normalization. After almost 6 years of highly accommodative policy, the risks are out there and continue to build, Powell began. He said that there wasn't worry about a financial meltdown in the core of the system, as had happened in 2008 when the big banks collapsed. He believed that the banks were better capitalized and regulated than they were in the past. What worried him more was the prospect of a sharp correction amplified by the liquidity mismatch in the markets that would damage or halt the process of what was still a weak economy. He was saying that a lot of traders and hedge funds had built risky positions using a ton of debt. If markets fell because inflated asset prices started to reflect their real value, then these hedge funds would start selling off whatever they could pay to pay their debts. But in such a scenario, not many people would be buying much of anything. This is what economists might call a liquidity mismatch. The Fed was laying the groundwork for a market crash, and the possibility only grew more likely with each passing month of ZIRP and QE. If this wasn't enough for the Fed to pull back, there was another important reason. By keeping interest rates at zero and keeping the banking system so flush with cash, the Fed was leaving itself with little room to maneuver if the economy did start to sink into recession. His speech was remarkable for its clarity, but it was remarkable for another reason. It appears to be the last speech of its kind that Powell delivered during an FOMIC meeting. Not too long after that, his attitude appeared to change. Roughly 7 months after delivering his warning, Jay Powell gave a speech at Catholic University in Washington, D.C., aimed at disarming the central bank's critics. By February 2015, when he gave the speech, there was growing opposition to the Fed in conservative and far-right circles. The movement was led by libertarian figures like Ron Paul, a former congressman and presidential candidate. Paul was a pushing movement to audit the Fed, giving the public a chance to better scrutinize and govern the central bank. Paul's followers were animated by the long-held fears of hyperinflation and currency devaluation. Powell said that the increasingly vocal criticisms of the Fed were misguided. In fact, the Fed's actions were effective, necessary, appropriate, and very much in keeping with the traditional role of the Fed and other central banks, he said. The Fed's conduct, in other words, was entirely normal. He went out of his way during that speech to defend the very policies that he had been warning about internally since he had become a Fed governor. He said that unconventional policies such as quantitative easing were largely responsible for America's economic growth, and that the critics of those programs had been proven wrong. After I joined the Federal Reserve Board in May 2012, I too expressed doubts, but the efficacy of and risks of further asset purchases, Powell said. But let's speak and let the data speak. The evidence so far is clear that the benefits of these policies have been substantial and that the risks have not materialized. Powell did not mention that he had warned in June that the risks of quantitative easing were not only materializing but were growing and could lead to corporate defaults and a financial market crash. His reversal was noted by his colleagues at the FOMIC who had previously argued alongside him. There was a shift, and I think it's noteworthy, said Richard Fisher, the Dallas Fed president. Fisher had been raising concerns about QE for years, and he believed that Powell played an important role in giving those concerns more weight. It mattered that Powell's office was just down the hall from Yellen's. He was important because he was a governor, Fisher said. Fisher was not aware of any study or new data set released between June and February that would justify a reversal in Powell's judgment about QE or ZIRP. There was no condition in 2015 that would have indicated or necessitated easing off that argument, Fisher said. More likely, he believed, what was the effect of being a Fed governor? The evolution may have well come from being there longer, being surrounded by brilliant staff that has a very academic side to them, and bias, Fisher said. You're living in a cloistered atmosphere. It's a different environment, and you're in that hallway. You conform more. I don't think there's anything nefarious about it. I think it's just the social dynamic. In closed-door meetings, Powell continued to cast doubt on the efficacy of quantitative easing. I think we've never looked at asset purchases as other than a second-best tool, he said during the FOMIC meeting in September 2015. I think that's been the way it's been talked about since the very beginning. Uncertain as to its effects, uncertain as to its bad effects, and certainly uncertain as to its political economy characteristics, he said. But a review of his comments, which are available only through the end of 2015, indicate that Powell was softening his arguments and his warnings. The language became less vivid and less focused on large and dynamic market crashes. As Powell's rhetoric appeared to cool, the Fed was starting to take concrete actions that addressed the risks he had warned about earlier. Janet Yellen moved forward on the plan to hike interest rates and stop quantitative easing. She was pushing to normalize in a very real way. In December 2015, the Fed raised rates for the first time in 9 years, boosting them by a tiny fraction from 0 to a range between 0.25 and 0.5%. The era of living at the zero bound finally appeared to be over, but it wasn't ending quickly. The FOMIC members believed they would raise rates all the way to 1.375% by the end of 2016, but they only raised them to 0.5%. The Fed had somewhat better luck in ending quantitative easing. The banks had stopped buying bonds at the end of 2014, but it wasn't able to reverse the loan program, as some had hoped to do so. there was still about 2.4 trillion of excess bank reserves sitting in the vaults of the primary dealers on Wall Street, and the Fed still owned 4.5 trillion in bonds that it had purchased through quantitative easing. The ocean of cash on Wall Street was akin to a permanent low interest rate. If the Fed ever wanted to truly tighten the money supply and reduce its pressure to search for yield, then it would need to start drawing this money down. The Fed was normalizing slowly in part because of the sheer size of the task. Access Bank's reserves were about 135,000% higher than they had been in 2008. The Fed's balance sheet was about 4.5 trillion, almost 5 times its level in 2007. Interest rates had been pinned at zero for nearly 7 years. Caution was the Fed's guiding principle as it sought to reverse these changes. The FOMC hadn't raised rates since June 2006, and it hadn't raised rates above the zero bound for the previous 7 years since late 2008. The American body politic was not moving cautiously in 2016 when Donald Trump was elected president. This was the abrupt, unexpected event that would end Yellen's tenure at the Fed. One of Trump's primary appeals was that he would work diligently to dismantle what was left of America's fiscal policy institutions. He set to work dismantling regulatory agencies like the EPA while passing a tax cut that would become a financial fiasco, enlarging the annual federal deficit to 1 trillion a year even when the economy was growing. Trump's animosity towards most government institutions was transparent, but his attitudes toward the Federal Reserve was less clear. During a 2016 campaign, Trump made a strange and provocative comments that made it seem like he would support the Fed's efforts at normalizing or and during a debate with Hillary Clinton, he responded to a comment about the struggle inside the middle class with something that seemed like a non sequitur. He started ranting about the Federal Reserve and talking about asset bubbles. Look, we have the worst revival of an economy since the Great Depression, and believe me, we're in a bubble right now, Trump said. The only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we have a Fed that's doing political things. The Fed is doing political things by keeping interest rates at this level. When they raise interest rates, you're going to see some very bad things happen. This comment didn't generate much traction in the campaign trail, and Trump rarely mentioned the Fed again. When he became president, however, he had a chance to imprint his influence on the central bank. Janet Yellen's term as Fed chairwoman would expire in early 2018. As the end of Yellen's tenure approached, Trump interviewed a handful of candidates to consider as Fed chairman, including Yellen herself. After meeting with Yellen, Trump said he was impressed. Jay Powell was hardly considered a frontrunner for the job. When financial traders and bank analysts made bets about the next Fed chairman, Powell was seen as a far outside chance. But Trump's Treasury Secretary, Stephen Mnuchin, changed those odds. Munich came from the investment banking and the hedge fund worlds, which would have given him a good understanding of Powell's previous career at the Carlyle Group. München recommended Powell directly to Trump. Powell was also impressed and had impressed Trump during the interviews. There was a view inside the administration that Powell and Yellen would essentially promote the same agenda when it came to monetary policy. What tipped the balance towards Powell was his approach to bank regulation. He was seen as more closely aligned with the Trump administration, which was working to scale back some of the regulation imposed during the Obama years. Trump went with Powell as his nominee. The Senate confirmed Powell quickly. Powell's selection was seen as a safe choice and a vote for continuity. But he was not a dissenter. He would continue the path laid out by both Ben Bernanke and Janet Yellen. The path, in this case, would be the path to continued normalization. The Fed had gotten off to a slow and halting start, and in 2015 and 2016, but during 2017, the bank started moving forward in a very real way. Powell was also seen in some quarters as an ally of Donald Trump. One key issue helping peel away the regulations that were put on big banks. The Frank-Dodd law that banking oversight was still divvied up among multiple agencies, including the FDIC and the Fed. This gave the central bank enormous influence over the rules governing Wall Street. Powell's vice chairman, the bank's supervision, was Randall Quarles, a former Carlyle Group employee, who had also worked for Jay Powell at the Treasury during the George H.W. Bush administration. Quarles had met with bank lobbyists in the Fed's boardroom in the Eccles building to hear about their concern. The Fed softened rules around the stress tests and eased back parts of the Volcker rule that would have given the bank examiners more power to assess how banks asset and valued their assets. At that time, Tom Hoenig was moving in the opposite direction. It was unclear at first what Trump's victory might mean in terms of banking policy and for Hoenig's career trajectory. Trump had cast himself as a hero of the working class and criticized big banks. Less than a week after Trump's election, the Wall Street Journal ran a brief story reporting that there was speculation Tom Hoenig might even be elevated to chairman of the FDIC. There was also discussion that Hoenig could join the Federal Reserve Board of Governors as vice chairman overseeing bank supervision, the job that Randall Quarles would eventually get. But by late 2017, the Trump administration needed to make a decision about Hoenig. His term as FDIC chairman was coming to an end. Hoenig said that he was willing to remain in Washington, but only as the FDIC's chairman or the Fed's regulatory chief. I did make it clear behind the scenes that for either of those two positions, I would be willing to stay a while, but not just to sit there, Hoenig said. He wasn't optimistic about his future in Washington. He had been antagonizing the big banks since he arrived, and he knew that these many fights had dimmed his chances at promotion. He even had been warned about it. It was suggested to me, rather indirectly, that I should tone it down if I'm expected to really have another opportunity to do these other things I might want to do, Hoenig later recalled. I just ignored it, because I don't have an interest in changing my views. But if that's what it takes, I don't need this stuff. In January 2018, Honig got his answer from the Trump administration. It came in a phone call from a staffer whose name Honig couldn't recall later. The staffer thanked him for his hard work. Honig was also informed that even if he wanted to stay at the FDIC, he no longer had the option. The White House had just nominated a senior banking attorney named Jelena McWilliams to fill Honig's seat. McWilliams was going to be the FDIC's chairwoman. In April 2018, Honig left the FDIC and returned to Kansas City. There was no doubt about what his departure would mean for the fortunes of the big banks. Bloomberg's News reported the story under the headlines, Wall Street's least favorite regulator is calling it quits. Becoming Fed chairman presented Jay Powell with a remarkable opportunity. He had been pushing the Fed for years to normalize its operations, limiting the downside risks of asset bubbles. Now he had the chance to lead the effort. He could be something like a modern day Paul Volcker, who ended up at one period of the Fed history and began another, even if it caused volatility on Wall Street. The process was already underway. The Fed had raised interest rates 3 times in 2017, bringing its target rate to 1.5%. Maybe even more important, the Fed began to reverse quantitative easing in October, selling off its bonds it had purchased earlier. The Fed promised to keep the normalizing steady during 2018 and beyond, drawing down the size of its balance sheet from 4.5 trillion to somewhere between 3 trillion and 1.5 trillion. The difficulty of this effort was apparent as soon as Jay Powell took the job. The Fed had barely begun to normalize, but the financial system was already falling apart. On Monday, February 5th, 2018, Jay Powell was welcomed to his first day on the job as the Fed chairman. The stock market plunged. The Dow Jones Industrial Average fell by 1,175 points, its largest single-day drop in history. Just a few days earlier, the average had fallen by 666 points. That's a really bad number, because we know that the number 666 is supposed to, symbolize Satan and evil and all that. But anyways, the largest single day drop since 2008. The market turbulence was not a sideshow. It was tied directly to the Fed. As the central bank normalized its operations, it was doing nothing less than rearranging the global economic order because it was now at the center of it. This reality was described in a 2016 book called The Only Game in Town by the influential investor Mohammed A. El-Iran, the CEO of the investment powerhouse PIMCO. When El-Iran talked about the only game in town, he was talking about the world's central banks. They had become the anchor of economic development as democratic institutions were increasingly mired in dysfunction around the world. The problem with this arrangement was that central banks weren't built for this job. All they could do was create more money. Somehow, the world was now depending on one set of institutions, central banks, with one of the narrowest sets of instruments at their disposal given the task at hand. El-Iran wrote, and the longer such policy was in play, the greater the probability that the costs and risks would start outweighing the benefits. When the Fed acted, its actions affected everything. The markets turmoil of 2018 had many faces and emerged from many places, but there was a singular, important force that was driving it. What appeared to be a series of unrelated market panics was actually the result of smart investors reacting rationally to what the Fed was doing. These investors listened to Jay Powell and took him seriously. The age of ZIRP was coming to an end, even if it was ending gradually. The big money had to move in different directions to accommodate this new reality. Powell's leadership from this front was steady from the very beginning. When he took charge, the FOMC hiked interest rates on a predictable schedule and at regular intervals. The banks sold off billions of dollars in bonds each month, sucking the excess cash back out of Wall Street and easing the very high pressure it had created to search for yield. The reason to do this, Powell said, was the economy's underlying strength. During his first speech as Fed chairman, he pointed out that the unemployment rate had hit 4.1%, a level so low that it was previously considered abnormal, an almost certain precursor to price inflation. The United States had created jobs for 90 consecutive months. The unemployment rate was as low as it had been since 2000, near the peak of the dot-com bubble. If the Fed couldn't normalize now, then when could it ever normalize? In June, the Fed hiked interest rates again to a range between 1.75% and 2%. This was the highest short-term rates had been in a decade, but it was still an early landmark on a long road ahead. If the Fed wanted to have significant power to cut rates in the future, when it came time to ward off a crisis, then the banks needed to push rates to 3 or 4%. There was no question that market volatility would intensify as normalization continued. But Powell was careful to end and tend relationships in Washington that would help him keep a steady hand if things got rough. During Powell's first 8 months on the job, he met with 56 lawmakers on Capitol Hill, splitting his time almost evenly between Republicans and Democrats. Janet Yellen, by contrast, had visited just 13 lawmakers during the same time period in her tenure. Powell formed connections that would provide him support if the Fed ever drawn into political disputes. As Powell built support, he continued the efforts to normalize, with the FOMC continuing to hike rates at regular intervals. The Fed was continuing to reverse EQ by selling off roughly $50 billion in bonds every month. During a news conference in late September 2018, Powell signaled that the Fed would keep tightening. "These rates remain low," he said. This gradual return to normal is helping to sustain the strong economy for the longer run benefit of all Americans. In October, Powell once again pressed hard on this point. During a public economist forum, he said that interest rates were a long way from being at the neutral level, meaning that they were still well below the level at which they neither helped nor hurt the economy or economic growth. The implication was that there were many more interest rate hikes to come. The markets fell sharply after this, with the Dow Jones dropping a 5% in just 2 days. Among the worst hit stocks were banks and energy companies. Powell might have quietly forged political alliance in Washington, but there was still one relationship that he could not manage: his relationship with President Donald J. Trump. The president began to wade into monetary affairs in the typical Trumpian way. by drawing wide attention to the matter and then getting people arguing about exactly the wrong thing. In this instance, Trump began to publicly pressure Jay Powell into cutting interest rates. This outraged the community of the Fed followers who believed the bank should be independent and free from political pressure. Powell suddenly became famous, but he was famous only as a foil to Trump's public tantrums. Powell became another Washington figure representing institutions that Trump sought to deface or destroy. The larger issue about the need to normalize, the cost of normalizing, and the complicated side effects of normalization all fell to the shadowy edge of the audience's view. Trump turned monetary policy into a circus, and he was at the center of the ring. Trump paraded his grievances about Powell in front of the television cameras and on Twitter. His central complaint was that the Powell had raised rates even as other nations were keeping their rates low. Trump's had once complained that the Fed was stoking asset bubbles. Now he took to the posture that rates needed to stay at zero and that the Fed should stop selling off 50 billion bonds each month. Stop with the 50 Bs, Trump proclaimed on Twitter in December. Feel the market. Don't just go by meaningless numbers. Good luck. The public dispute between Trump and Powell helped overshadow the slow, chaotic unraveling of the global financial system. By the end of 2018, the reality of normalization was beginning to express itself. The direct relationship between the Fed's actions and the market volatility was obscured, in part because there was always a short-term explanation, a new headline of the day to explain what was happening. When the value of technology stocks began to fall, for example, the headlines described the increasing political scrutiny on monopolistic companies like Facebook and Google. These headlines were accurate. They really were an increasingly powerful movement to regulate technology companies. But a larger force behind the stock market decline was the Fed's normalization. When the Fed diminished its pressure on investors to put their money into stocks, the investors first withdrew their money from the stocks that were most overvalued. These include technology stocks, which had drawn so much attention from investors during the years of ZIRP. As the global economy started to slow, the headlines described the effect of President Trump's trade war and tariffs against China. These headlines were also accurate. Trump's actions were unpredictable and disruptive, slowing global trade and causing investors to re-examine and even rearrange supply chains. But once again, the larger force was the Fed's normalization, which coincided with similar actions from other central banks. In December 2018, the European Central Bank followed the Fed's lead and ended its own version of quantitative easing. The tightening financial conditions exposed the rot that had formed in the global debt markets. China was a particularly instructive example. It was suffering from a debt crisis and a wave of asset bubbles that its government and central bank helped create over the years. A Fed report from 2018 put it succinctly. In China, the pace of economic growth has been slowing recently, and years of rapid credit expansion have left lenders more exposed in the event of a slowdown. Private sector debt in China had nearly doubled since 2008 and amounted to more than twice the level of China's annual economic production. This enormous level of debt could trigger adverse dynamics. as borrowers found themselves unable to repay in the event of an economic slowdown. The trade war overshadowed a deeper problem in China that had to do with the cheap money and high asset prices. December was the pivotal month. There was a broad global downturn that was scary in the way that it seemed to affect everything. Usually, markets for different assets and different commodities move in different directions. When stock prices fall, for example, gold prices rise as investors rush for a safe haven. This didn't happen in December. Instead, the downturn was broadly synchronized across asset classes in a way that shocked Wall Street traders. Stocks ended the year down about 6%. Even high quality corporate bonds ended down 6%. Crude oil prices and other commodities were down 15%. It was the beginning of a global retreat from risk and a reshaping of the economic system after ZIRP. If the instability continued along this course, it could threaten the global central banking system, intensifying the global economic slowdown, or even lead to another financial crisis that could cause the unemployment rate to jump quickly. Jay Powell had made a choice. In mid-December, to stand firm in the face of these risks, normalization would continue. During a press conference on December 19th, Powell said that the Fed would continue to reverse the process of quantitative easing by selling bonds on automatic pilot. He was saying that the Fed would not be deterred by the market turmoil. Financial traders took Powell at his word and responded rationally. They started dumping their riskier assets. On Christmas Eve, a normally quiet trading day, the Dow Jones Industrial Average fell by 653 points, nearly 3%. This smelled like the panic to the Wall Street types. The Dow was now about 19% down about 19% since October, just 1% point short of an official bear market, meaning a downturn that generally presages a recession. A terrible economic reversal was in the making. When the full shape and scope of this economic tyrant came into view, it would only be a matter of weeks before Jay Powell surrendered entirely. On January 25, 2019, a story leaked to the Wall Street Journal. It turned out that the Fed's reversal of quantitative easing might not be as automatic as Jay Powell said earlier. In fact, the story said unnamed senior Fed officials were close to deciding that the Fed would keep more money on its balance sheet than it had originally expected. Markets rose on the news. After the FOMC meeting that month, Powell emerged to give a news conference. He began his comments with a litany of technical points and data, but he didn't obscure the central message. Normalization was effectively over. The bond sales were over. The interest rate hikes were over. The tightening was finished. The case for raising rates has weakened somewhat, Powell said. Powell's language was colorless, but the traders on Wall Street heard his message clearly. Powell's reversal had been total. The moment coined a term in the investing world, the Powell pivot. This phrase was just another way to describe the safety net that Wall Street assumed the Fed would provide. They called it a put, as in contrast to buy a stock at a floor price if it ever sank too low. First, there was the Greenspan put. then the Ben Bernanke put, then the Yellen put, and now the Powell put. It had become a de facto policy. The Fed put implied that the Fed would create a floor to asset prices. By February 3rd, days after this announcement, the values of stocks and bonds were rising in tandem, a rare thing to see. It soon became clear, however, that simply stopping normalization would not be enough. The world economy was like a big building with bad wiring that was smoldering behind the walls. Some rooms were smoky, but some rooms were just hazy, and it seemed that open flames might break out at any moment. Deflation was a central problem. Demand was weak, and industrial production was slowing in Germany and in China. Prices were stubbornly across the European Union. In March, the Fed announced it would be keeping interest rates flat, and Powell acknowledged the puzzling lack of inflation was a large reason. I don't feel we have convincingly achieved our 2% mandate in a symmetrical way, he said. It's just one of the major challenges of our times. We have downward pressure on inflation. By March, shares of stocks and banks were falling and falling over worries about the financial system, and the specter of the global recession was becoming more pronounced. The market sent out a particularly stark warning that the month when interest rates on short-term bonds became higher than those on long-term bonds. This is something called an inverted curve yield that signals a coming economic downturn. In July, the European Central Bank announced it would cut interest rates largely because inflation remained alarmingly low. President Trump tweeted his fury about this development. He believed that the Fed should be leading the way on rate cuts and stimulus, not the ECB. In July, Powell led the Federal Reserve to do something extraordinary. The bank would cut interest rates even though the economy was growing. The unemployment rate was 3.7%, the lowest it had been in about 50 years, and wages had been rising. This was the point in an economic cycle when the Fed normally kept rates higher, giving itself the power to cut them if the U.S. economy began to slow. The rate cuts were described as an insurance policy. The traders on Wall Street suspected that this insurance policy was just the beginning. Future market priced in 3-month rate cuts by the end of the year. Central banks around the world, from Europe to China to Russia, started to ease again. They were the only game in town, and by August the banks were fighting off a global downturn. If Powell felt like he had control over the situation, that feeling was extinguished on the Tuesday morning on September 17, 2019. The members of the FOMC gathered that day in Washington for their regularly scheduled meeting, but the meeting was overshadowed by urgent reports from the trading desks at the New York Fed. An obscure but vitally important market for overnight loans had seized up. The problem was getting worse. If left unattended, it would lead to a financial crisis, maybe worse than the one in 2008. Very few people outside of Wall Street even knew what was going on. The economy was as strong as it would be for years to come, but the entire financial system was so fragile that it was about to implode, which we know that it ultimately did because COVID came in and helped further its destruction. But anyways, that was the end of chapter 12. We're going to leave off there and pick up next time on part 3, Let Them Eat Assets. and chapter 13, it's called The Invisible Bailout. Anyways, if you enjoyed the reading, please like the video so it can go out to more views on the YouTube algorithm, and hit the like button and subscribe to the channel, please, so that way we can get more people informed about what the Fed really is doing to our money, because the money is supposed to be ours, but yet they're the ones manipulating it, devaluing it, making it harder for everyday Americans to really have what used to be called the American dream, because our money's so worthless now that you have to make around 150,000 a year now just to be considered middle class, which is very sad because most people in the US don't make 150,000 a year anymore. So anyways, please hit the like button, and if you have any comments, leave them in the comment section below, and we will read again in the next video. So each of you have a good night.